Hey everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and market updates. It's the darkest hour for US debt not yet has reached, and the SEC has recently embarked on a demining process. The Securities and Exchange Commission's Financial Stability Oversight Board has set up a hedge fund working group. Recently, the U.S. Treasury yields has risen sharply, triggering a correction in asset valuations in global markets, especially the U.S. stock market. So, the U.S. regulators are understood to be considering curbing trading in response to the risk of trading with hedge funds, thereby endangering the financial system. The SEC has set up a hedge fund working group, which is working on preliminary plans and evaluating options, including urging banks to collect more data on exposure and raising funding costs. In addition, the Biden administration is working on a broader measure to identify companies outside the banks as systematically important companies, which could be included in hedge funds. So-called basis trading is a kind of use of the spread between Treasury futures and the spot market profit trading strategy, namely when the future market's bond price is significantly higher than the spot market. Hedge funds can short futures and through the ripple market borrowing to do more spot bonds and other securities as collateral to earn the spot futures price convergence. This trading strategy will flourish until 2020. In March 2022, the U.S. Treasury bond market was stalled by the lack of liquidity of U.S. Treasury bonds, which amplified the panic of selling caused by the epidemic. It did not return to normal until the Fed intervened, adding about $1.6 trillion in the March to May period, with basis trading recovering over the past year. Borrowing from treasuries in the repo market is reached in nearly $3 trillion, a record high. As a main source of financing for basis transactions, the sponsor repurchase of the U.S. Fixed Income Clearing Corporation has risen rapidly since the beginning of the year. Although most of the repo market activities of hedge funds occur in the non-central clearing bilateral repo markets, and few are conducted in the central clearing repo market through FICC, the increased demand for sponsor repo also reflects the recovery of basis trading heat from the side. Meanwhile, the Commodity Futures Trading Commission show leveraged funds has near record net short positions on 2 years, 5 years, and 10-year Treasury futures in recent months, matching long positions at large asset managers. Here, Fed economists highlighted the risk of a potential financial vulnerabilities related to these transactions in the two recent reports. There is now significant price volatility in Treasury market due to rising yields and uncertainty about the Fed's interest rate outlook. Cash futures basis positions may come under the pressure again during the broader market correction. Given the risks, tradings need to be continually and closely monitored. On September 8th, Fed economists said in a separate report that the basis position could be quickly unwound if the repo funding costs rise. They warned that this would increase market selling pressure and could amplify volatility in the Treasury bond and increase chaos in the Treasury, future, and repo markets. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.